Hi, and welcome to this special and educative episode of Market Talk, where we will cover the bond markets, the yields, how they move relative to each other, and some basic theory regarding this asset class. So let's dive in. So hi again. Welcome to this educative episode of Market Talk, where we will be focusing on bonds and interest rates. We will talk about what is a bond, how these bonds are priced, and we will talk about the difference between the interest rates and the yield of a bond. And more importantly, I will make sure that you understand the important relationship between a bond's price and its yield. So a bond is a fixed income instrument. It is called fixed income because it brings a fixed income to its holders on a regular basis. So the issuer of a bond could be a company like Nestle, for example, or it could be a country like Switzerland or the US. So if a company issues a bond, it's called a corporate bond. And if a country issues the bond, it is called a sovereign bond. But both the corporate and the sovereign bonds function the same way. They all have a face value, also called a principal value. They all have a coupon rate and a maturity date. So let's talk about these three. So as I said, all bonds, corporate and sovereign bonds, have a principal value, also called the face value. So it's generally a round number. It could be $100, it could be 1,000 francs. This is what a bond is worth at the time it is issued by a company or a country. It remains unchanged, but then the price can change. So the principal value, the face value, is always the same, but the price changes. I will come to that later. Then, all of these bonds have a coupon rate. They pay a fixed coupon on regular intervals, or they don't pay at all, but every year you could expect to be receiving, for example, $5 coupon for holding a bond with a $100 face value. So you would have a 5% coupon rate there. And finally, all bonds have a lifetime. So you can buy a bond that will come to maturity in 2 years. It could come to maturity in 5 years or in 10 years. And at the maturity date, you as an investor will receive your principal back and you're done. Note that you can also buy perpetual bonds that never die, but you know when you buy a bond, what is the time span of the bond, and you just know when you will be getting back your principal if there is no default, of course. This is not true for a stock, mind you. When you buy a stock, you simply own it until you sell it, or until the company defaults, but until you sell it in theory. So in summary, you buy your bond, it lasts until it comes to maturity, and ideally it pays you a prefix coupon every now and then. There are no coupon bonds as well, but generally speaking, this is how it is made. And if you want to sell your bond before maturity, you can do it at the market price of that moment. Now, note that the bond's face value is here not equal to its market price. And this is where it will get maybe a little bit more complicated. So please bear with me and take your time to listen a couple of times if you have to really understand how this works. So your $100 bond costs $100 at the time it is issued, but it doesn't necessarily cost that $100 at all times toward maturity. It will go up and down, so it will cost you $105 at some times, it may cost you $95, so it will gain or lose value as time goes by, as all assets. And when we talk about bonds, note that we don't talk about the price of a bond, but we will rather talk about its yield. So the bond's yield is simply the return on a bond investment, and it is in percentage terms. So instead of saying that the US 2-year bond, for example, is worth $98 today, we will simply be saying the US 2-year yield is about 4% today. And because there is this negative relationship between a bond's market price and its yield, well, some people could easily get confused here. So it's really important to be careful with the two, the price and the yield. So listen carefully. When a bond is issued, as I said before, the price equals its face value and its coupon rate equals its yield. So if we take the previous example, for example, if your yearly coupon rate on a bond is 5%, the bond yield is going to be 5% at the issuance. So it will bring you 5% annually. If, however, the price of a bond goes down and you buy it for a cheaper price, then your yield will be higher than the coupon rate. That means if you buy a bond below par, so below its face value, cheaper than what it was, here it would be $100, for example, well, you will still receive $5 each year or each period. And because you got your bond for a cheaper price, well, your yield, your return on investment is going to be higher. Similarly, if the price of a bond goes up and you buy it for a higher price, you will still receive $5 coupon per period, but you paid your bond more expensive than its face value. So the overall return that you could expect to get on your bond investment is now lower. So your bond's yield is lower as well. Therefore, well, you have to remember at all times when you are trading a bond or you're buying or selling a bond that when the price of a bond goes up, well, its yield goes down. And similarly, when the price of a bond goes down, then that means that its yield is going to go up. And this negative relationship between the bond and a yield never changes. Now, there are a couple of other relationships in this bond space that you must also be keeping in mind when you're trading, buying, or investing in bonds as well. When the interest rates, for example, from the central banks rise, a bond's yield rises as well. To get the price of a bond, you basically discount the coupon payments to today at the time of T, and the higher the interest rates, well, the lower the bond price. It's just mathematical reality. And the lower a bond's price, the higher a bond's yield. Then you have other relationships that are probably more straightforward. For example, you have the fact that higher risk companies or higher risk countries and their bonds pay higher coupon rates to obviously compensate for the risk that investors are taking to hold, to invest in these bonds. I think that's pretty much normal. It makes perfect sense. Then the longer maturity bonds tend to pay higher coupons compared to the shorter maturity ones to compensate for the longer period of time that investors renounce to their capital and remain invested in a bond. So that's also very much understandable and goes perfectly in line with common sense and economic theory. And finally, well, corporate bonds also pay higher coupons normally than their respective government bonds, and that's basically because the risk of a corporate bankruptcy is seen as being higher than the risk of a government insolvency. So you should get a smaller compensation when, for example, you buy a Swiss government bond rather than when you buy a Nestle corporate bond. So that really also goes very much with the idea of, well, more risk means more return. And you could ask, who decides if a bond is risky and how risky a bond is? Well, it's a handful of rating agencies like Moody's, Fitch, and Standard & Poor that you probably heard the name, who decide whether a company is risky and or how risky it is or they are. So these rating agencies assess ratings to companies and also to governments. For example, your US government bonds used to have a AAA rating at Standard & Poor. It now has a AA plus rating at the time I'm recording this video. On the other hand, Apple also has a AA plus rating, by the way. So the probability of seeing Apple go bankrupt at S&P is pretty much the same than seeing the US government go bust. It's quite interesting, but well, this is how it is. Switzerland, for example, has a AAA rating, which is a great rating, whereas Nestle, which is a Swiss company, has a AA minus rating, which makes more sense. Now, note that different rating agencies have different ways of rating companies and governments, but as a general rule of thumb, the more A's and the more pluses you have, the better it is. So I will leave it here for this educative episode of Market Talk with probably a small headache behind me, but please do not be overwhelmed with all this information because it obviously does take time to digest all these relationships if you are not familiar with them. So just maybe watch again if you need to. I'm İpek Özkardeşkaya and thank you for joining me. So please do not hesitate to leave your comments and your reactions and also your questions below as you do usually. Please also follow us on Instagram, on X, and on LinkedIn for regular market updates that we post every day, and subscribe to our YouTube channel for daily market updates, and also hit the like button to let us know that you enjoy these market talk episodes. And please don't hesitate to let us know if there are any subjects, any topics out there that you would like us to cover. And until then, goodbye.